RITES, the listed PSU catering to railway engineering space, has seen some impact because of COVID-19 situation as well as the lockdowns. However, as against the investors' initial apprehensions, the company is now confident about growth as its facilities have now resumed work, and also on the back of the strong order book it has. In our ideas for profit today, we'll discuss if this stock warrants investors' attention at the current levels that it is trading at. Let us look at the earnings highlights first. Now, during the March quarter, the company actually reported 22.5% decline in revenues on a year-on-year basis. Now, RITES operates in three key segments, namely consultancy, turnkey, and exports, and that's along with small leasing business as well. Now, the biggest impact was actually seen in the turnkey as well as the export businesses, which account for about 40% of the revenue and register 35 to 40% year-on-year decline in the revenues as deliveries suffered due to the lockdown. Thankfully, the consultancy business, which actually accounts for the bulk of revenue or about 54%, actually saw marginal 9% year-on-year decline, and thus the overall impact was definitely mitigated. Now, the consultancy business saw a good spurt in the operating margins as well. EBIT margins saw a close to 500 basis points improvement, and since this segment accounts for the bulk of revenue, this really helped and rescued the overall profitability from the impact of the margin erosion in the exports as well as the turnkey businesses due to the lower scale as well as the high fixed cost. Now, this is also a reason that despite a sharp fall in the total revenue, its EBITDA dropped by just 10% in the March quarter on a year-on-year basis. Now, going forward, Q1 FY21 would still have some impact because of COVID-19 as well as the lockdowns, and it is expected that the execution will normalize only in the second and third quarter and expedite towards the fourth quarter of the current fiscal year. Moreover, because of the secured government business, the margins would not really deteriorate substantially, and thus the earnings growth would actually get impacted only marginally from here on. Now, we do expect a marginal 5% decline in the revenue this year and a recovery of about 18% in the fiscal year 2022. Now, lower tax rates should also support and add to the profitability front. The order inflows have been good so far. The company has recently delivered 6 DEMU orders to Sri Lanka and was also able to get a repeat order there. Now, it has also bagged an export order worth 700 crore rupees from Mozambique, and interestingly, by March this year, the export orders had jumped to 1436 crore rupees with a growth of 23% year-on-year, and substantially higher from the 771 crore rupees kind of order which it had till the December quarter. Now, the company's total order book by March quarter stood at over 6100 crores as against 6000 crores in the corresponding period of last year. Now, the current order book is equal to about 3 times its annual revenue and also provides good revenue visibility from here on. As far as the valuations are concerned, it has corrected from its 52-week low toward 191 and also sharply recovered in the last few sessions to about 259 rupees per share. Now, even at the current levels, the stock offers reasonable value. It is currently trading at about 8 times FY22 estimated earnings and also offers a dividend yield of about 6%. So, one can definitely look at the stock as it offers good return ratios, low debt, strong order book, as well as a good revenue visibility.